Yeah, Brad, thanks for having me today. Tell everyone a little bit about yourself and kind of what you do. And
Yeah, I've got a face for radio, so this is the first time doing film. I'm an accountant for a reason, but I've been an enrolled agent and certified financial planner for 18 years, give or take. And I do tax preparation and planning, compliance, also do some wealth management and financial planning. Today, I'm just here to talk to Gary and his people about kind of the ins and outs of taxes in real estate. I'll just say that no accountant, no matter how smart they are, knows all the tax laws. They change all the time. I don't remember how many pages there are in the tax code, but there's a lot. But I would just say, real estate, when you're talking about those types of sums, it can be a big amount for any client. So you want to definitely probably lean on a professional in that area when you get those types of tax questions. Someone can back it up and give you good information.
Right, which is great advice. So we were introduced through Marty Smith, who's a great loan officer. He's one of the best in the business, CMS Mortgage. I came to him with a question. I've had a couple clients come to me. They say, Gary, we really want to sell our vacation house on the beach. However, they know they're going to get stuck with taxes, either whether it's going to be capital gains tax or, if it's a rental property, it would be like a 1031 exchange, but they wouldn't. They'd be deferring the taxes. But for those of us who are those of them, not me, I wish I owned a beach house. For those who owned a beach house now for many years, it's been in the family, they want to sell, kind of talk about their situation. Like what's to be expected when they sell?
Sure, if that's a situation where, the property has been in the family for a long time, is that what I understand?
Yeah, family. Been in the family for a long time, it's never been a rental.
Just a vacation property.
Second weekend home for them.
Yeah, absolutely. I mean, from the financial planning perspective, I would take a look at what their ultimate goal is. If they really truly do want to sell that place and maybe upgrade to a different location. Unfortunately, the 1031 exchange rules wouldn't apply to that situation. But if you know that ahead of time, maybe you can do some things. It would take a little bit longer, but creating maybe a rental cash flow situation with that property for a certain amount of time that would qualify you to some extent to defer some of those taxes by satisfying the 1031 exchange rules. So that's one option. The other option, what I mean by look at it from the financial planning perspective, and I realize I'm talking to the realtor that's trying to sell the place, is if you have a huge deferred gain on the property, if you've got elderly folks that want to leave it to their kids, that might be the alternative is, that you get a step up in cost basis when the founders pass, and then there's no taxes for anybody, which is a nice value add. Like I said, I know who I'm talking to, so consider that one with a grain of salt. But the 1031 exchange rules, they're pretty straightforward on the surface. You've got 45 days to identify as many properties as you want. You got 180 days or 6 months to close on it. You can do multiple properties. You're basically just trying to replace the full fair market value of whatever the business portion of that part is. And you want to have similar net equity at the end if you don't want to have any taxes triggered, So there is some magic there. It's not a silver bullet like I mentioned before, but definitely talk to your tax pro, especially if you got one in that specific area, that local area that you're working with.
Got it. What are some other challenges or obstacles that they may come into contact? What are some other scenarios besides doing a 1031 exchange? Obviously, you mentioned earlier that if they were to pass away and their kids took over that property, are they going to get reassessed, or is it going to be like it was where they could take on that property tax?
That's a great question, and one that I've gotten a lot of. To give you some background, Prop 13, which I think we all know and love in California, would allow you to, back in the day, transfer your property tax base to your kids. You could do that before death or after death, pre or post-mortem. A few years ago, the first dent in the Prop 13 armor was Prop 19, which was, basically saying, hey, we're not going to allow the parent-to-child transfer anymore for all properties. We will let you do it with your primary residence as long as your kid moves into your primary residence within 2 years, treats it as their primary residence, and oh, by the way, you only get about $1 million of protection on the reassessment. Now, don't let that scare you away, because what can happen is if you have a either a rental property or a vacation property, and you have the original purchasers that pass away, yes, you will likely get a reassessment, especially if it's a rental property. But what also happens is the basis, which is the part that you get to apply to the depreciation schedules, which is if it's a residential rental property, that's 27 and a half years. I mean, that's gonna, if mom and dad paid 50 grand for the house and now it's worth $1 million, now your depreciable basis gets stepped up from 50,000 to $1 million. So that's a substantial annual write-off that you will now get if you keep that rental property, and that will likely offset the increase in property taxes that you end up getting. So I have a lot of clients walk in the door that are wringing their hands about Prop 19, but usually once I explain to them, hey, if you're gonna keep it as a rental, you're gonna get a lucrative tax write-off in that stepped up basis of the property. You don't get to apply it to the total building. I mean, only the building portion is what you get to apply it to. Land isn't, or depreciation doesn't work on land, basically. So you have to come up with the formula of what's what. But Southern California, we got smaller houses with big price tags. You can make the case for a lot of it is building in our area. There's more formulated and safer ways to claim it that I won't glaze your guys' eyes over with right now, but that subject comes up a lot, I would say, especially since Prop 19 passed a few years ago. So, but the one value add is, seniors can now pretty much move anywhere in the state while they're still alive and transfer their property tax base. If it's their primary residence, they still get a $500,000 capital gain exclusion under Internal Revenue Code 121. That's for married couples. A single guy gets $250. Yeah.
Every 2 years or what?
Yeah, so the rule says you have to live in the property and own it for 2 out of the last 5 years. So that's another little real estate trick that you can think about. So I have a lot of clients that are considering moving out of state at various points in their life, and they're not sure if they like where they're going to end up, so they may, convert their California property to a rental property and then go rent in that state where they think they want to stay. And if they like it, what they can do, because of the IRC 121 rules, is you can actually keep that thing as a rental for up to 3 years, because it's, they lived in it for 2 and you add another 3 years. That's our 5-year window. And if they sold that property within 3 years, even though it was converted to a rental, they still get the full primary residence exclusion when they sell it. They take the proceeds, buy 3 places in the other little state, and they're happy. Or worst case scenario, they hate that place that they went. They realize that that's pretty cool. You can go to the beach and the mountains in the same day. They come back, kick the renters out, and now they're still in their house and they're fine. So that's something that I see pretty often.
What would you say to those who have no choice but to sell and they're going to get stuck with the capital gains? Can you explain that a little bit more, like what that would entail?
Yeah.
Is there any type of, obviously you said if you own it 2 out of 5 years, a married couple is $500,000.
Right.
Is there depreciation, or is there any kind of improvements that you made to the house?
Yes. So what I tell most people, we do back of the napkin math. It's like, we're taking our gross sales price, reducing it by realtors' commissions and closing costs. That's the top dollar number. And then we're taking what you originally purchased for the place, which you can usually look up on Zillow or look at your old closing docs. That's the original kind of unrealized gain there. But you can also go and look for items of improvement in the house that were substantial improvements to the house. So it doesn't include maintenance and things like that and fence repairs, but roofs and really upgrading the place. You get to add that to your basis. I only send people out looking for that stuff if it looks like they're going to be shy of that $500,000 exclusion or have a little bit more gain than the $500,000 exclusion. So when I'm getting clients and I'm talking to them during the tax planning meetings, it's like, hey, that roof or those improvements that you're doing, I'm doing some in my house right now. I have a binder or an email folder where I'm just dropping the invoices from all those guys in there, and I'll have that as backup for life, for just in case. Who knows? You know, I don't know if you read the papers, but I think our projected market growth is like 16% for the next 3 years in Ventura County. I don't know if I believe that, but I want to make sure that I have enough of those little basis increases that I can add when or if I get ready to sell my place, because there is no 1031 exchange on a primary residence. It's only business property. So, and then to kind of further elaborate on a rental property, just if you straight sold it, there's different tax rates that apply. You know, if it was a rental for a long time, and you basically have a building, the building part, and you have the land, you know, and that building part, usually it's about 60% or 70% of that building. You take a deduction that's really not coming out of your pocket. You know, it's offsetting the income that you're receiving from that property. Well, the IRS says when you go to sell that property, that part that you wrote off that offset ordinary income is going to be recaptured at ordinary income tax rates. So let's say hypothetically you have $1 million property, and let's say that you had $200,000 of depreciation over the years, and let's say you paid $500,000 for the place originally. So if you sell it, you've got a $500,000 gain, which is $1 million less your original purchase price, $500,000 capital gain. 200 of it is subject to higher ordinary income tax rates that usually cap out at 25% for this specific 1245 IRC code. The rest is subject to long-term capital gains rates, where, you know, most people would be 15% max on that for federal purposes. We live in the lovely state of California. California doesn't care about capital gains. Income is income. So that's 9.3%. So I would tell most people to expect 25% Fed and state taxes on the gain portion, and then round up to 35% for the portion that's subject to taxes. So this is where you want to talk to your accountant in the middle of the year, not during tax season, and go, hey, Brad, can you run a projection for me on this? You know, and then really get the bottom line, what's it going to cost you, kind of thing, to do this if you're just going to do a straight sell.
Got it. Well, that's a lot of great information.
I don't know about
a little
great.
bit over. Well, I mean, for people who are watching this, who they're in this scenario. I mean, a lot of people who own homes in the beach in Oxnard or the marina, it's a second home to them, or it's been in their family. They bought it for $100,000. Now it's worth $3 million. So this is something that comes up a lot more. And I think with the continuous growth of Ventura County, it's going to be something that's going to be more and more likely to have happened.
Yeah, I agree, 100%, especially if you believe the growth rates that everybody's projecting for the county. I mean, it's one of those things, it's, you know, I lived through '08 as an advisor and tax guy, and that's the only time I can think of in recent memory where home values actually went down. We had a heck of a lot more surplus back then. Now we've got more people with less inventory, and you know, I mean, I think the conditions are right for prices to be supported for a long time. You know, if we get a situation where the Fed may lower rates, we'll see, and get a little bit better mortgage interest rate, you know, that could be a catalyst for prices to go up even further. I know that I'm happy about that as a homeowner. I feel bad for my clients that are renters out there, you know, but it is what it is.
There's definitely a lot of, like myself, you know, having 2 kids in the past 3 years, needing a bigger home. There's a lot of people are sitting on these sub 3% interest rates, a lot of pent up buyer demand, and you know, once the Feds, if they do lower interest rates, I think it's going to blow the lid off of the real estate market.
I agree. But I think there is a bit of stagnation. I'm sitting on a low rate myself and couldn't imagine a situation where I'd want to unplug that unless my wife talked me into it. But you know, I get that. So I mean, if we get any cooling off in the interest rate world, which there's a lot of pressure on the Fed to do that. They're not supposed to listen to that stuff, but they are getting it. And I think they're looking for any kind of cooling off point. The last inflation reading was promising. That's good. I think you've seen it in the equity markets recover recently. So we'll see how it all works out. I mean, I think I saw where even rents were cooling off overall for the most part. That's a big impact on that CPI. You know, I think it makes up 30 to 40% of the consumer price index is the rent or rent equivalent that people are paying. So yeah, I think, you know, just in general, I hope that cools off for everybody that's trying to raise a family. You know, I got 2 kids at home too, and it's expensive. You know, I think everybody's feeling it these days.
For sure. So if you're feeling it, you need some advice, you're pretty easy to get a hold of. What's the best way to get a hold of you?
I never go home. I'm always here. I live a mile away. No, I'm here Monday through Friday, usually 9 to, you know, I won't put a time on it, but you call the office and you'll get Lynn, my secretary, my wife, Rachel's the office manager, small family practice here. Don't have to be a client to ask a question. If I don't know it, I probably know somebody down the street that does, or Marty probably knows somebody that can answer your questions.
But if they're in Camarillo, Hooks Tax and Wellness Solutions.
Hooks Wealth and Tax Solutions.
Hooks Wealth and Tax Solutions.
You can tell from my waistline, I'm probably not in the wellness business. But Hooks Wealth and Tax Solutions. We're over off of Flynn Road where all the other boring accountants are, but love to talk to whoever you guys send our way.
Awesome. Great talking to you. Thank you,
Gary.
In my experience during COVID, for example, I had quite a few clients trying to complete 1031 exchange transactions that had a really tough time identifying the properties and closing on them within the designated time period, which is 45 days or 6 months. And I would say that they create these investment products called Delaware Statutory Trust. I won't name specific products, but you Google that and you'll probably find one out there. That's just kind of a safety net. So if you can't, always identify that one as one of your few properties, and then that way, if everything falls through at the real properties, you have that one as a backstop. Worst case scenario, your equity goes into that fund, you get a paycheck for the rest of your life. It's pretty tax efficient because you also get depreciation deductions on that. So that's one food for thought, I'd say, as well.
Yeah, especially if interest rates go down, it's going to be a feeding frenzy. It gets really hard to identify properties and do that. So.
Yeah, or just someone that's really tired of being a property manager. Say they've been a property manager because it's a pain, especially if you're taking advantage of these, qualified business income deduction. Most of those are folks that have rental properties that don't hire a manager. Well, the federal government lets you take a 20% write-off because of that in most cases. But it's a lot of work, especially if you have multiple rental properties. So I've seen clients where they want to unwind that and they don't want to have to deal with replacing it and putting it into another property. So they put it into one of these Delaware statutory trusts, which is basically a real estate investment trust or a REIT, structured a specific way to receive those assets and then give you a paycheck for a long time. So that's another
a great nugget. A great nugget to know about.
There. Yeah.
Awesome.
Exactly.
Appreciate all your time. Always thank you again.
Yeah, absolutely.